Hi, everyone. Thank you for being here with us today. I'm Rebecca Negro Rocha, the manager of growth programs at Endeavor. And today I have a very special guest of our Endeavor network to talk about the scaling up journey and most especially fundraising. We know this is a tough topic for founders, especially at this time, and we couldn't think of anyone better to share their story on this. On that note, I'd like to welcome Carlos Ganoza, Endeavor entrepreneur, Endeavor mentor, co founder of Quantum Talent, which was acquired by Wanolo in 2022.
Hi, Rebecca. It's a pleasure to chat with you today. Thanks for the invitation.
Likewise, Carlos, thank you so much for being here. I'm excited for us to be having this conversation. This is a topic that so many of our founders keep bringing up to us, and I think it would be great for them to learn a little bit about your journey and how you dealt with it as well. Um, so I'd love for us to get started with you sharing more your story, how it all started, how did you become even involved with the Endeavor Network, and of course, that fundraising process. And then for everyone watching, we're going to then transition to talking about Carlos' biggest learnings of the fundraising process. So on that note, Carlos, I'll turn to you. If I have any questions, I'm going to shoot them at you, and then we'll work off of each other a little bit like that.
Excellent. Excellent. So let me first start briefly with my story. I'm I'm an economist, and I started my career thinking about solving big economic development problems from a policy perspective or from an academic perspective. And I became an entrepreneur after a long career in the private sector and academia and the public sector, because here I realized that being an entrepreneur gives you more freedom to have impact and change people's lives. Um, and that was actually my motivation to become an entrepreneur, and I validated or confirmed that intuition throughout my experience as a founder. So I started Quantum Talent um, to solve a problem that was very close to my heart, which is that in Latin America and throughout the world, um, labor markets do a really poor job at including uh, low-income people and underprivileged segments of the labor population. They're constantly being discriminated against or don't have the resources to be able to participate effectively in the labor market, find jobs that are right for them. So we built an AI technology to be able to predict job person fit and match people with the right jobs for them in minutes. We scaled that throughout Latin America, and last year we were acquired by Wonolo, which is the largest on-demand staffing marketplace in the US. And that's in a nutshell my journey as an entrepreneur and how um, my career took me to that path.
That's great, Carlos. Thank you for giving that overview. Why don't you tell us a little bit of what was it like to scale this company in Latin America? We know that, well, many countries have similar markets. We know LATAM, maybe Brazil are different challenges. Also, you were creating and leading a company that was very technologically advanced. How was that process like as being an innovator in the field compared to what others were doing, right? Can you tell us a little bit more about that?
Absolutely. So scaling to we started in Peru, which was where I was based at the time, and expanding to other countries at first seemed incredibly easy, and then it was incredibly challenging. It seemed incredibly easy because um, our, our first expansion was to Mexico, and one day we got a phone call from one of Mexico's largest companies saying that they were running an open innovation program. They had, I still don't know how they had found about us. We were still like a very, very early stage company, which is a handful of customers in Peru. And they wanted us to participate in the program. After discussing it thoroughly with the team, because we felt we were not ready, which is, we were just starting to gain early traction in Peru. Um, we decided to participate. We ended up winning. It was like an open innovation contest in which this company invited startups from across the world to pitch different ideas as to how to solve the problems. And in this case, they had chosen like the talent acquisition as their main area of innovation. So we ended up winning the contest and working with this company. And then a couple of other companies saw that in the news, or heard about us through word of mouth, and approached us. And at that moment we're like, wow, this is easier than what we expected. We already have like 3 or 4 customers in Mexico, one of the the largest Spanish speaking market in the world. But then going from there to actually achieving sustained and scalable growth was incredibly challenging, and I think that was probably one of the toughest parts. Crossing borders in LATAM and establishing presence in each country it's completely different countries, different markets, different ways of buying, different networks, um, different ways to spread the word around and to get yourself um, out there and in terms of our technology, that was also very challenging. So we were a deep tech company in Latin America. That's unusual. We were working on cutting edge machine learning technology. We were very lucky because we were able to build like a top notch, world class machine learning team, and that's the most important reason why we were acquired was because of our technology and our team. Um, but it required that I spent a substantial part of my time um, acquiring talent, expanding my network across the AI and ML talent pools in Latin America, and always pitching the company to potential employees, especially very talented, highly sought after ML engineers and data scientists.
Was there a moment in this journey that you thought that everything was on the line and that you thought maybe, you know, there was not going to be another day with Quantum Talent? And how do you think you guys were able to overcome that in the face of adversity?
Yeah, pretty much every week, I would say.
I hate that that's the reality of so many founders, but yeah, that makes sense.
Pretty much every week. And it was such a roller coaster. I mean, we achieved like a huge milestone or something really important, won like a huge account, and then something terrible happened a few days after that that may led us to question whether we would be able to keep growing and scaling or raise more funds. And then of course the pandemic made everything substantially more complicated. We were building a two-sided matching platform. Our revenue model was more like a SaaS B2B revenue model. So we were selling to companies that were hiring very large volumes of hourly employees, and they were using our technology to predict who was right for the job. And and when the pandemic started, all those companies in Latin America stopped recruiting, stopped hiring. Actually, they've been laying off people, so they stopped using our solution, and we lost 70% of our revenue in 1 month. Um, and then throughout the pandemic, also when we were in the process of doing a strategic pivot and to expand to the U.S. because Latin America wasn't growing fast enough. We suffered the default of one of our lead investor, um, and left us instead of having like 18 to 24 months of cash, left us with like 2 or 3 months of cash. So we faced some pretty rough rides, and I think the most important things that allowed us to survive and manage to be acquired by a leading company in our space were, I would say, three things. First, we had like a really clear mission. We were super clear on what we wanted to achieve, and that always provided certainty in terms of the tough decisions that we had to make um, when adapting the business to the challenging conditions that we faced. The second was that, and it's related to the first one, we had a team of missionaries rather than mercenaries. So people who were deeply committed to our mission, who really believed that we had a chance of changing the world, of improving the lives of millions of people. And they were among the most brilliant people in their fields in Latin America. And so they never jumped ship, right? When the situation got really tough, and that happened many times, they were just there, and they kept rowing even harder, pushing the car even harder with more strength because they were so committed to what we wanted to achieve. And I would say the third um, was that well, we had our issues with investors. As I said, one of our investors defaulted on their investment commitment. We also had, actually, most of our investors were incredibly supportive and always there for us, and felt our mission very close to their hearts. And they always understood that this, wasn't going to be an easy ride. That this was we were building deep tech in Latin America, trying to do something that nobody had ever done before. It was incredibly risky. It was going to be incredibly challenging. We're basically trying to climb the Everest without the right equipment and with a crew that had never done that before. And they were always for us, and they always had like wise words of advice. They were always ready to cheer for us when we had tough moments, and that was so helpful. That was incredibly helpful.
And that's usually what a lot of successful founders say, right? That well, actually, all founders say that, the right investors can make it or break it for you, right? And I'm glad to hear that they were able to help you in that journey, especially when things got so difficult with the pandemic. Taking now what you just said about, your investors, I want to switch gears a little bit and start talking about what were the biggest learnings that you had in this fundraising process, right? And as we do make the transition, and I'm going to step away so that you can actually go through your lessons learned, I would love for us to kick things out off by sharing a little bit about you raised capital both in Latin America and the United States, right? That is not something that all companies can speak to, right? Or that they have been able to do. Tell us more about how that process went and how would you compare contrast and also some lessons learned in the process. So yeah, I'll leave you that with that question as we transition to the next part of the session.
Sure. So, to a certain extent, they were similar, and but also very different. Similar in the sense that at the end, raising capital for a startup, I think, has a lot to do with um, how you're able to communicate the your story in a way that's appealing to the right people at the right time. Um, the difference is that in Latin America, um, there was, especially when I was racing, there was a shortage of capital, an extreme shortage of capital, and particularly in Peru. Like, we only had one venture capital fund in Peru, and it was a very early stage, very small fund. And most people were angel investors or family offices without much experience in startups or investing in early stage tech companies. Um, while in the US, at that time, actually, there was an abundance of capital. People were getting funded with crazy ideas, with just a PowerPoint deck, and but you need to have like the right network or be able to navigate successfully through, or in the right way to be able to sit in front of the right person at the right time. Um, so as a Latino founder in the US, I think that was the hardest part. Being able to like crack the network and get to talk to the right people at the right moment. Um, but at the end, like the basics or the fundamentals of how you tell your story and how you convince an investor, how you find fit with an investor, I think it was pretty much the same.
Got it. No, thank you for sharing. I think it speaks a lot on the journey of an immigrant as well and how that compares and contrasts. So thank you for sharing. We're now going to transition for those watching to talk a little bit of what were some of Carlos's biggest lessons and learnings from this time of fundraising as a founder in Latin America, expanding to the US, deep tech technology. So Carlos, tell us, what would you do would have done things differently, or what do you wish you had known at that point in time?
Sure. So I'm going to share basically three principles that I learned throughout the process of raising funds and chatting with many other founders who had raised funds successfully and unsuccessfully, and also talking to dozens and possibly hundreds of investors, VCs and angel investors. Um, and when I was thinking about what title to how to title this brief presentation or these slides. First, I thought about like advice for normal times, because the first thing that we have to recognize is that the times have changed. The past few years were crazy. with people getting funded with no strategy, with no business solid business model. And that's, I don't think anybody can give solid advice for times like that, like those. So my advice is really for normal times, and luckily we're now in normal times, so it's going to be more helpful. Can we go to the next slide, please? I control this. Okay, great. So the first one is, or the first principle I learned is that really a successful funding strategy is going to be the result of a very sound business strategy. So when a founder is first thinking about raising cash for a startup, whether it's like very, very, very early seed stage, to fund basic R&D, or a bit more advanced, Series A or even Series B, um, a good funding strategy has to be able to provide solid answers to the questions of how much money I will raise, at what target valuation, how much dilution I will have, what type of investors, maybe to a lesser extent with what type of instrument. And I say to a lesser extent because that can be preset by the stage of the company and the type of investor. But good answers to those questions will tend to be firmly grounded in the growth plan of your business. If you don't have like a very a firm grasp and a very rigorous and thorough plan for how your business is going to grow, there's no way you're going to be able to answer those types of funding questions. So the size of the round is basically a reflection of a solid understanding of what investments make sense at this stage to take the company to the next level. Um, do you need to invest in product? Do you need to invest in new markets, expanding to new markets, expanding your distribution channel? How much does it make sense to invest at this stage? If the company doesn't expect to be profitable after those investments, what do you need to de-risk to to make it to the next round? And your investment should be geared towards that process of de-risking the company. So in the next round, it's going to be easier to raise funds from other investors that are going to be looking at your risk profile in a different way. Do you need to prove go-to-market fit? Do you need to prove you can crack new segments of the market? So understanding the stage of the company and what you need to achieve and how you're going to achieve that will basically produce a solid funding strategy. And I think many founders, or I've seen many founders fall into the trap of just trying to tell a great story, very inspirational. That's part of it for sure. And that maybe can get you past the first meeting. But if you really want to make sure your fundraising is successful, that is that you need the money to take do you have the funds and the type of investors you need to take your business to the next stage, then you really need to think more thoroughly about your business strategy and avoid falling into the trap of using valuation as a success metric. I've also seen many founders fall into that trap. Valuation in early stage startups is like the uttermost vanity metric. And people can fall into the trap of thinking that maximizing valuation is what they have to do for their investors. But that's wrong. You have to maximize the long run value of your business, not necessarily maximizing the valuation that you get in a specific round. And choosing a valuation target that makes sense given what you think that the business will be able to achieve in the next 24 months and the value that you expect that the business can have after you reach those milestones is the right way to think about valuation. Um, and sure, everybody wants to raise as much capital as they can, but think about it more as a buffer, and not just raising more capital as a buffer, not just raising more capital because it is being offered at a nonsensical valuation. Treat capital as if it was very scarce. That means that you want to have spare capital at your disposal, but you don't want to waste it in things that you really are not sure, right? Um, so I would say that's the first principle. Always tie your funding strategy to a solid business strategy. The second would the second principle is to treat your potential investors like you treat potential customers. Or another way in which I like to frame this principle is, you'll have to kiss many frogs to find your prince. Because not every successful business will appeal to every investor. Everybody's focused on like tier one investors, top-notch investors, the most prestigious VCs. Those are not necessarily the right funds for every single type of founder or every single type of company. Um, and too many entrepreneurs believe that they have to pitch their businesses as the next decacorn or the next huge company. And that's not only not necessary, but also not convenient either. If you really have a business with that potential, with a product that can build a huge moat in a gigantic market, then go ahead and pitch it as an ex decacorn. But not all successful startups will be decacorns, and not all VCs are in the business of looking for unicorns or decacorns. So you have to understand the investment market like you understand your customer market. Segment it. Understand how different types of investors think and behave. Think about the value proposition that those investors offer to their LPs, and how that is going to fit with what you offer as a company. As how can you add to that investors portfolios? Different VCs and investors have different interests depending on the size of their fund and their investment thesis. Smaller funds maybe will be happy to invest in a company that doesn't grow to be a multi-billion dollar company. With a larger fund, there's no way they're going to invest in you if they don't really see that potential. And if you change your mind along the road and you say, I'm happy with just being a $500 million company and not a $10 billion company, they're going to be very disappointed. Even if you produce an incredible yield, they're going to be very disappointed. So you want to be sure that there's a good fit between you and the investor. Just like you want a happy customer, you want a happy investor. That doesn't necessarily mean that the business always has to have an easy ride. That's not possible. It means that the investor knows what he's getting into. And precisely because of that, they will be very good companions when things go sour, or where things don't go, when things go bad, or when the ride starts getting rougher. And that will happen for sure. That's why it's important to find investors that truly understand your business, that care a lot about what you're trying to achieve as a founder, and who will be rooting for you and help you when things turn bad. So you have to look for the frog that's going to turn into a prince, because then that's the type of investor who will always be rooting for you and always be willing to help you when things get tougher. And the last principle is that you can really choose um, 2 out of 3 characteristics when raising funds. In the crazy market that we've just been through, you see all types of things. But in general, if you want to go for a higher valuation and good investors, investors that understand your business, that understand your goals, that will be rooting for you all the time, it will take you time. It's not going to be fast. So you're going to have to sacrifice speed. You're going to get price. That's a good valuation. You're going to get quality. That's investors that are right for you. But it's gonna take time, and that can be a long time. If you want to raise fast, you will need to either settle for a lower valuation or lower quality investors. So you'll have to pick your poison, right? Um, so depending on the situation of the company, I would always advise that you prioritize quality and then choose between speed or price. So you first, prioritize getting the right type of investors on board. And if you're running out of funds, or if you need funds quickly to take advantage of a good opportunity that can dramatically accelerate your business, don't worry too much about valuation. Um, if you can wait, then sure, choose a valuation target that is a bit more ambitious, as long as you don't make it the main goal of your funding strategy. Always remember principle 1, right? Don't fall into the trap of a high valuation. Um, but be realistic. I see too many founders thinking about raising capital only when they realize that they're not going to make it to the next stage, and they have 6 or 10 months of cash. You have to be much more strategic than that and realize that depending on what you want, you're going to have to time your funding appropriately. Um, so those would really be the 3 principles that I think are most important for founders to take into account when they are preparing to raise funds, or when they're thinking about how they're going to raise funds for their startup. First, a good funding strategy will be the result of a solid business and growth strategy. What you need to achieve as a next milestone to be able to raise more funds if you're not going to be profitable with that round, and you know how you're going to use that money to get to those milestones. You're not going to fall into the trap of a high valuation, and you're always going to think about capital as a scarce resource. You want to have a bit more than what you need, a buffer, but you don't want to waste it. Then the second is that you know that you're going to have to kiss many frogs to find your prince. It's not about racing fast. It's about racing with the right type of investors, because this is going to be a tough journey. And the third is that you have to prepare, because there's no way you're going to be able to raise at a high valuation with the right type of investors and in a very short period of time.
Carlos, thank you so much for sharing those insights. It's always great to hear from founders themselves, in especially such difficult topics. To wrap us up, considering the market that we're in right now and how capital is limited, entrepreneurs are still needing to fundraise. Do you have any words of advice for entrepreneurs listening? Anything for them to keep in mind, or something that you would do if you were raising at this point in history?
So basically, keep those three principles in mind at all times. And again, those are three principles for normal times. During crazy times, anyone could raise. Anyone who was a good storyteller or who had the right connections could raise with a simple deck without any solid business model or promising business idea. So these are really three principles for normal times. We're in normal times right now. Um, Funds, VCs are really going to do their job when screening and assessing founders. We still have a huge amount of capital ready to be deployed. So there's a lot of capital around. It's just that, but it's not that easy for VCs to deploy that capital and magically expect valuations to keep rising. So they will be more diligent about how they screen and assess opportunities. But there's still a lot of capital to be deployed.
Carlos, thank you so much for everyone watching. This is Carlos Ganoza, Endeavor Entrepreneur, Endeavor Mentor. Carlos, thank you for joining us and sharing some of your golden nuggets with everyone in our community. And yeah, thank you so much and hope to see you soon.
Thank you very much for the invitation, Rebecca. It was my pleasure. Thanks.
Awesome. Bye, everyone.
Bye.